Actually, the title here is a bit misleading because this is more a bit loud topic, like I wrote here in the whiteboard. It's more like a discussion about how to preserve our gains rather than doing a detailed P&L analysis. But let's listen to our presentation, to our short video first.
You know, in the world of investing, making a profit, that's really only half the battle. The
Okay.
real challenge, it's keeping it. Today, we're going to break down exactly how to protect your gains and start thinking like a pro, all through the lens of a good old profit and loss analysis.
And let's start with this quote, because it's pretty much the most important rule in what we call the game of preservation. See, this isn't just about the excitement of picking a winner. It's about the discipline and the smart, tax-savvy management that makes sure those gains you worked so hard for actually end up in your pocket.
So, to really master this game, you've got to adopt the mindset of a professional. And for a pro, the most important clock isn't the one on the wall. No, it's the fiscal calendar.
And this right here highlights a fundamental shift in how you should be thinking. While a lot of people might track their portfolio month to month, the pros, they live and die by the tax period. So why is that? It's simple. Capital gains taxes get triggered when you sell. That means timing your exits, especially as you get close to the end of the fiscal year, is absolutely critical for your final after-tax return.
Here's a really simple, repeatable process you can use. First, get into your P&L tools and select the specific tax period you want to look at. Next, filter all your transactions so you can clearly see your realized gains and losses. That's the stuff you've already sold. And finally, compare those booked numbers to the potential gains and losses sitting in your open positions. This gives you a perfect snapshot of where you stand with your tax liability.
And that brings us to a really crucial distinction. To manage your portfolio like you mean it, you need to be crystal clear on the two different types of gains you're dealing with. The ones you've already locked in, and the ones that are still just potential profits on paper.
Realized gains are pretty straightforward, right? You sold the asset, the profit or loss is officially booked, and yeah, it's on the taxman's radar. It's a done deal. But unrealized gains? Oh boy, this is where the mind games really begin. These are your paper profits, and while they look fantastic on your statement, they are not truly yours until you actually hit that sell button.
And honestly, this is the most psychologically dangerous part of investing. That big, unrealized gain can feel like a nice, cozy safety cushion, but it can also be a massive trap. It tempts you to hold on for way too long, it can cause you to panic during market dips, or it might even make you miss out on way better investment opportunities just because your capital is tied up.
So you have to constantly ask yourself this question when you're looking at your portfolio. Are those paper profits genuinely providing you with a cushion for the future? Or are they trapping you in a position that, let's be honest, if you were looking at it with fresh eyes today, you probably wouldn't even buy?
Okay, now let's get into some pro-level moves. We're going to cover how to intelligently manage your tax bill and, I think more importantly, how you can objectively measure your own performance as an investor. Are you actually any good at this?
Let's say you've had a fantastic year with some big realized gains. Well, you can use strategies like tax loss harvesting to manage that final tax bill. This just means selling some underperforming assets to realize a loss, which can then cancel out some of your gains. But you have to be super careful with the details, like the wash sale rules, and always remember one crucial thing.
And here's that crucial point. Your main goal is to build a smart, high-performing portfolio, not just to get your tax bill down to zero. You've probably heard this saying before, but never, ever let the tax tail wag the portfolio dog. Making a bad investment just to save a little on taxes is a classic rookie mistake.
Now for the real work, figuring out how you actually performed. And to do this, you've got to go beyond the simple gain or loss number on your statement. You need to use two key professional metrics, the money-weighted return and the time-weighted return.
First up, money-weighted return, or MWR. Just think of this as your personal rate of return, your personal scorecard. It's heavily influenced by your decisions to put money in or take money out. For instance, if you deposit a big chunk of cash right before the market takes off, your MWR is going to look great because it reflects your good timing. It really measures how well you performed. Next up is time-weighted return, or TWR. Now, this metric is completely different. It strips out the impact of your cash flows. It answers one simple question. How did my investment choices perform, completely separate from when I added or took out money? This makes it the perfect, cleanest way to compare your strategy directly against a benchmark like the S&P 500.
So by comparing these two numbers, your MRW and your TWR, you can finally get an honest answer. You can see how much of your success was just the market rising and lifting all boats, and how much came from your own skill in picking assets and timing your cash. This is how you separate true alpha from just being plain lucky.
Okay, let's bring it all together with what I think is the most important principle of capital preservation, the one golden rule that should guide every single decision you make.
You know, governments offer all sorts of tax incentives, but you have to be careful. Sometimes they're a trap. They can lure you into illiquid stocks or really low-growth assets just for a tax break. Your focus has to always be on generating strong competitive returns first. Tax optimization should be a result of a good strategy, not the thing that drives it.
At the end of the day, true capital preservation isn't about hiding from the tax man, it's about being systematic. It's about reviewing your trades with real discipline, tracking your true performance, knowing when it's time to take profits or cut your losses, and always letting tax benefits follow a smart strategy, not the other way around. And that brings us to the most important question of all, the one I'm going to leave you with. The real measure of your success. It isn't the profit you see on your statement. It's what you actually have left after all the taxes and fees are paid. Do you know that number?
Okay, back to our discussion, and in fact, back to where a little bit a while ago. And let me remember again that let me look at this. The first important thing in terms of the gains preservation is that we should always be aware of the tax calendar, and the tax calendar is not the same in every country, as of course, but you know your own country, and but in some other countries, for instance, in my country, it is from January to December. Is the same thing as the calendar. But in other countries like the UK, where it starts in, I think, on the 7th of April, for instance. So you have to be aware of that, and you should actually do your management in terms of capital preservation, bearing in mind the taxman calendar, basically. That's one important thing to retain. The other important thing to retain is that it's not so common, but it happens also a lot. You have to be aware of so-called incentives or tax-favored accounts and so on. So all governments offer all types of preferred accounts or preferred where they reduce the taxation or offer some other types of incentives. And the problem with these government-sponsored investments is that they may often be a trap rather than a really good incentive, and or it may make your life a little bit more complex because you have to split your investments into let's say a savings account or a investment savings account like in the UK or a KO1 in the US, and very often some of those accounts also favor some types of assets, some types of funds, and you can easily imagine that the lobbies that have a greater influence over the politicians are the ones that, of course, are trying to sell second-rate products. So you have to be also aware of that. But there are obvious advantage in using some of the tax-exempt accounts that you can use. Likewise, it's similar to the offshore centers that try to attract you on the basis of their favorable tax treatment. But again, you have to be aware that there are no free lunches, and of course, you have to be aware of the pitfalls of some of those schemes. Because in the end, they were never done to benefit you. They are always done to benefit the the sponsors of those products that they try to entice you to buy. So that's some care that you also need to take into account when selecting your investments and your accounts. It's something important to also to bear in mind. And we have here a note on some of these. I think, let me just check if, yeah. Okay, some of the problems I was telling you that you should always, again, it's also important that to realize that an investor doesn't need to be a tax expert. And it's always good to rely on outside tax advisors because I mean, if you want to become aware of all the tricks and complexities of various tax schemes, you better ask a professional, not try to do it on a do-it-yourself basis because you may not realize all the implications of that. So if you want to do some kind of tax management planning or tax planning, you should always rely on some outside tax advisor, not on your own advice. But it's important to be aware of that. And if it makes a difference, if you makes a big impact on your after tax return, of course you have to use a tax advisor that can guide you through the various pitfalls that people face when dealing with taxation. And of course, you need to time your. We have talked this about a lot, but never too much to remember. You have to also discuss and consider the timing of your profit taking or stop losses. We had a session just on that. But when reviewing your position, you should at least consider these questions that you have here in this slide. So was your price target already achieved? Is it going to rise or it's going to stable? Was your theory, the theory behind your investment choices broken, or is likely to be broken in the near future? Okay, so if it is that the case, you should consider selling, right? Or if the trend is still on, is still blowing your stocks, so of course you should keep them. So this is always a decision matrix that you should use to let run your profits and or take your profits. So it's always and that of course is an important part of capital preservation and gains preservation as well. Another topic that you should consider is, let me see, is whether you need to use if you need to use outside advisors or whether you should do it yourself. So when you need to do, as I told you, tax avoidance, you should use outside tax advice. In terms of investment advice, you may, of course, be your own advisor, as long as you take into account some of the topics that we have been discussing here about capital preservation, about performance, and about keeping your gains. But that's the message. So we can now go back to our assessment of our portfolio of stock pips, the one we left before, and go and look at some of the issues that are important to consider. Let's take the example of the SADIF stock picks, which is actually interesting because here we have that basically we are issuing stock picks every month. So we are following a strategy of staggered investments, so investing. But we have also limits in terms of the total number of stocks that we need to have in our portfolio, because there's a limit in terms of trying to optimize the size of the portfolio. So basically, if we continue with our approach for another 2 years, for instance, to get a reasonable period of 3 years, we will be building. We have now around 50 stocks, or maybe a little bit more here in our portfolio. So at the end of 3 years, we would have 150 stocks in our portfolio. That, of course, is not reasonable. So we need to, on that account, we need to start managing our portfolio while trying to keep constant the number of stocks we have in our in that portfolio, right? So that's one of the things that we learned before, and it's of course important when we in this evaluation stage to take that into account. So when doing that, of course, we need to see how we're going to then to manage this process. Shall we sell the stocks and reinvest the money and incur the tax costs of such a process, which we haven't incurred so far? Or should we just keep with the current strategy and sell some of the stocks using a different approach? So this is again a management decision that we need to take into account. If you want to preserve, the same size of the portfolio throughout the period, and we need to take that into account. And so one way of doing that is go then to our evaluation section and look at our P&L to see how we are doing now. And you can see that we have done already, we have sold 14 positions. And we have sold these positions, and because our strategy, as you can see, is mostly a strategy of sorry, I have to go here. It's basically a strategy of selling the stocks that are losing money. So we have here a negative value of 256. So and divided at the end of the year, so if we were going to close the portfolio now, then you would have, as I think, if I remember correctly from yesterday, we'll have something like a net gain of around 400,000. Paying a 30% capital gains tax, because it was invested just for 1 year, so we basically end up with less than 300,000 in the on this exercise. So what we need to do is how we can start reducing our we still keep the same discipline that whenever a stock loses more than 30% in relation to the market, that we should sell it. So we keep the same policy. But what we should do now from now on is we need to start selling our winners. So we have here plenty of winners. And then we need to sell our winners to make sure that we manage to offset as much as possible this negative these losses that we have here in order to offset some of these losses, but not all of them, because we want to carry some losses until the end of the period, because otherwise after the 3 years, when you're going to close the portfolio, then we would have a big tax bill to face. But again, which one should we sell? Shall we sell the ones that are in sort of in that narrow band around the market? Or shall we sell the big winners, or some of the big winners, and so on? So this is again a very important management decision that is going to impact on the results that we will achieve at the end of the after-tax results that we'll achieve at the end of the 3-year period that we committed to keep these stock picks. So you see, this is a measurement decision that we have to take now, because otherwise it will affect the final result. Because for the time being, we are measuring the results basically in terms of a price change. But at the end of a period, we need to measure our results in terms of after tax. So we need to measure our results after tax, comparing that with, of course, the benchmark. And the reason why that is important, because after a 3-year period, we need to know what is the impact of taxation on an alternative investment in the market ETF, compared with the achievement that we get in our portfolio. So it's a very critical decision. Finally, the final question is, and going back again to our return analysis, is whether what is the impact of using external advice. Let's imagine that we were going to use an advisor that would charge the typical hedge fund fee of 220, which is nowadays a bit on the high side. But let's imagine that we were going to use that. What would be the impact on our portfolio? Okay, let's change this to SPY. Okay, I have here calculated not only the management fee of 2%, but also the performance fee in our portfolio so far, and you can check immediately what will be the impact of our return relative to the ETF. So our return, our 40% we had here, would be, if we were using an advice, or if we were paying ourselves the same type of money, would be 35% that I would have to compare with the passive investment that would be investing in the ETF without any management costs. Okay, so it's important also to see what is the impact on our return. So it would mean a 5% in just 1 year. So of course, as we go on until the 3-year period, then it will be much higher, this impact. It's also useful if you are an advisor to try to understand how much money you're making you could expect to make in fees, and see if that money is enough to give you a reasonable income, even if you are successful as you were here. So you see, with a small amount of less than, I think it was about 2 million. Sorry, how much we invest? $3 million US is too small to to allow you a living. That's the reason why many of the would be hedge funds usually need to start at least with a minimum of 5 million, ideal 100 million, to secure enough fees to survive in the business. And one of the reasons why is not so much because they are bad managers, at least some of them. The reason why such a high percentage of active fund managers give up is because they don't manage to keep their investors, and they don't manage to reach the minimum size of their assets under management of around 100,000. So that's again one of the reasons. But if you want to be an advisor and get a couple of clients and manage your clients using the SADIF platform, then you have here a very good tool to let you know how much you need to attract in terms of assets under management, and also what will be the impact of being more competitive in your fee structure and so on. So this is again a little tool that can be useful. Okay, let's then conclude. So capital preservation should be really the name of the game, but not just capital preservation, but preserving your gains. So that's really not only and that's what you need to consider when you want to be an active investor. Okay, so this is all for today. We'll be back tomorrow with the last session about learning and learning by doing. Okay, thank you very much. See you tomorrow.